Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. And Nation, in all the chaos and the crash of 2020, it has actually been a surprisingly good year to invest. I revealed 5 stocks back in April, 5 stocks to buy with the most potential this year, and these picks have surged in that time. We're up between 30 and 70% just in the last 8 months, beating the market by double digits. With analyst estimates for rebounding economic growth next year, I think we can beat even those returns and really take your portfolio to a new level. So putting together our portfolio of stocks for 2021, I wanted to do something different here. We already highlighted those 5 dividend stocks that I'm buying for that cash flow and return. In this video, I want to add to that list 5 more stocks to buy for even higher upside. Then on Friday, I'm going to be revealing 5 penny stocks for those moonshot investments. I'll be putting each video inside our playlist on the channel, the best stocks to buy for 2021, so make sure you check that out for the entire portfolio. We're going to get started, but first I wanted to show you the sectors with the most upside potential before we get into that list of the 5 top stocks to buy. Stick around though, because after that, I'm also going to reveal those 10 stocks to avoid. 10 stocks that analysts think could plunge by 10 and 20% in 2021. You know, we can't get started though without a shout out to all you out there in the Bowtie Nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. So first, I want to show you the returns expected in stocks of each sector. Now, I love looking at this higher level first, seeing which sectors of the economy that analysts think are going to do the best, because it can really make investing in those individual stocks so much easier. For example, we see here that analysts expect stocks in the energy sector to surge higher, producing a sector level return of 45% over the next year. Now, knowing that, we can look for those best stocks to buy in energy to not only get that tailwind from the entire sector, but also an even higher upside shot on those best picks. Of course, the bounce in energy has been from the apocalypse in oil prices that we saw earlier in the year. The price of crude has rebounded to about $45 a barrel, and with these production cuts that we've seen with a lot of the drillers, if OPEC plays nice and keeps its own supply off the market, we could see $50 a barrel oil again next year, which would be a huge sentiment boost for a lot of these companies. Now, just looking at this graph, it seems analysts expect returns in energy to pretty much dwarf everything else. But I don't want you to go all in on this sector. There are a lot of other sectors here with some great potential, and I think some individual stocks that can easily produce these returns of 20% or more. So you can see here, you've got expectations for stocks in the healthcare sector and financials to both produce around a 14% returns on average. And this is followed by an expected return of about 13% in communication services and 11% in consumer discretionary and material stocks. I really like the healthcare and the financial space. Both have underperformed the market this year. Healthcare with an 8.6% return, and stocks in the financial sector, so those banks, brokerage, and insurance companies, they've posted the second worst return after those energy stocks. And healthcare, it might seem counterintuitive though with all the focus on health this year, but the hospitals, the doctors here have really been playing triage with their services. All those higher profit elective surgeries and the other services just been put on hold to care for these virus patients, so earnings have plunged. But this could all change in 2021, and healthcare is one of my favorite long-term themes for investing. Nation, we're all getting older and spending more money on our health, so this one has some great demographic forces behind it. And for the financial sector, if you've been watching the channel, you know this is another one of my favorite themes for 2021, and we're already up 33% in shares of Citigroup in our 2021 portfolio. And the optimism here is really a function of 2 catalysts. At first, the banks have taken tens of billions of dollars off their earnings to hold as cash in what's called a loan loss provision account. This is a special cash reserve that the banks use to cover those estimated loan defaults if the economy gets bad, and it's meant that earnings have just cratered this year. If we get any kind of an economic recovery, though, in 2021, I think they reverse all that we've seen here. They move that cash back into earnings and surprise on the upside, along with big increases in their dividends. The second catalyst for financials here is in interest rates and really how they make money. For banks, it's the difference in those rates paid on deposits, so those short-term rates, and what they collect on those longer-term loans. The interest rate on the 30-year Treasury bond plunged to a record low of 1.2% this year. So even with those short-term rates near zero, banks just aren't making any money. And it's not just the banks either in the financial sector, but insurance companies. They sit on those mountains of cash to pay those claims, but they're not getting any kind of return on those safe investments like bonds and money market funds. Now, analysts expect the long-term rate to edge back up to around 1.7% next year, and if it can even get back to that 2%, so where it was in 2019, that would be a boon to earnings for these banks. So those are the sectors I'm watching for 2021 returns. But you want the goods, right? You want those individual stocks to buy for those double-digit returns. So in that April video, we looked at those top 10 stocks with the widest difference between the average analyst estimate and the current prices, and it helped us produce those returns between 50 and 70%. So I thought, hey, let's go back to that. But right now, all the stocks in this list, the stocks with the highest return potential, are in that energy sector. Some of these shares have actually already come up as well. For example, we've got a 44% return on our shares of Diamondback Energy, that's ticker FANG, and a 54% return on Devon Energy, that's ticker DVN, in our Bowtie Nation portfolio. Now, I do think there's still some good upside left in those shares of Diamondback Energy, and I'll detail it in one of our 5 stock picks. But again, I don't want you to be 100% in one sector. As well as energy stocks might do in 2021, I want to give you a list of 5 stocks across different sectors that are going to give you those double-digit returns, but also some diversification. So I researched both Morningstar and Credit Suisse for their top recommendations, as well as some of my own favorites for a short list of the 5 best. Don't forget though, stick around after these 5 stocks for the 10 worst stocks to avoid losing your money. First on our list of 5 best stocks to buy, tech leader Broadcom, ticker AVGO. And surprisingly, not only does this one offer a great upside, but also a 3.2% dividend yield. Through acquisitions, Broadcom has patched together one of the broadest leaderships in tech, from smartphone components to wired infrastructure and to storage and semiconductors. If you want one tech stock that's going to benefit from some of the strongest trends like robotics, Internet of Things, and 5G, this is going to be it. But whenever I see a company built on that acquisition model, so buying up all these other companies, I run straight to the financial statements to make sure that it's not getting in over its head in debt. Broadcom has over $43 billion in debt, which is about twice the equity, but also has over $8.3 billion in balance sheet cash, so leverage is quite a bit lower than at first glance. Now, the company generates over $6 billion in operating earnings a year against just $1.7 billion in interest. So another metric that gives me that assurance on that leverage. What I really like about the company, besides the catalyst that I'll highlight next, is that not only is this company growing sales at a solid pace, it's learning how to do that, how to be more efficient to boost earnings. Sales grew by 8.3% last year, but the company was able to grow those operating earnings by 13.5%, which just is an amazing spread given Broadcom's size and those recent acquisitions. The release of the Apple 5G should help boost sales, and many of the company's products are primed to benefit in that work-from-home trend. The big catalyst here, though, I think is going to be that transition to 5G. With the new 5G technology, you can get thousands of devices on any local network versus the dozens of devices that you might be able to cram on there in a similar 4G network. Now that's going to drive the IoT revolution, but it's also going to mean a lot of network congestion and a spike in demand for those kinds of RF filters that Broadcom excels in. Earnings are expected 17% higher over the next year to $24.93 a share, though I think it gets closer to $26 per share earnings. The shares can trade between 18 to 20 times earnings with good investor sentiment, which puts us at a price target of around $500 a share. Anthem, ticker ANTM, isn't the largest healthcare insurance, but it is one of the largest with over 42 million members in 23 states, and it is the largest single provider of Blue Cross Blue Shield coverage. Now, United Health is by far the larger insurer, but here's why I like Anthem just a little bit more and why I actually put it into our 2021 portfolio. Now, Anthem is in just 23 states versus United Health's national coverage, but at 42 million members, it's a close second to that 49 million members covered by UNH. And it's because in the states where it operates, Anthem has a much deeper market share, upwards of a third of the market in each of those states. It's got an exclusive license with Blue Cross in 14 of those states, which is arguably the most trusted franchise in health insurance. This just all works to give Anthem a lot more negotiating power with its providers, helping to lower costs, pass some of those savings onto its customers, and keep some of it for higher margins. And with the election behind us and most likely split control of Congress next year, that uncertainty around healthcare stocks has really cleared up. We could see marginal changes to the regulation, but I think the worst is off the table. And again, healthcare is one of my favorite sectors in both the near term and longer term. Revenue grew at a 7% pace over the last 3 years, which the company was able to then turn into a 20% annual earnings growth. For the coming year, earnings are expected lower by just about 1% to $22.48 per share, but management has a strong history of beating these expectations. On a price to earnings of 18 times, a multiple the shares traded at just last year, I think this one gets back to $404 a share really quickly. FedEx, ticker FDX, is one we highlighted a few weeks ago as a best of breed in the industrial sector, and I wanted to add it to our best overall portfolio as well. FedEx is the world's largest global express shipping company, and the demand picture here is just amazing. I mean, most companies have to figure out a way to create that demand for their product before they can expand their operations. But for FedEx, that demand is just booming already. E-commerce sales spiked 37% in the third quarter and hit 16% of total retail sales this year from just under 12% previously. That trend to shopping online has been boosting sales for FedEx for years, but gave it supercharged growth this year, and the momentum is just going to keep on going. Now, were it only for that e-commerce shipping trend, I might say the shares are a little expensive here, but we've got another catalyst that isn't fully baked into these shares yet. With the COVID vaccines coming out, we are about to move into the biggest distribution problem in modern history. Not only do we need to get those vaccines to 7.8 billion people around the world, and FedEx is already ramping up for that, but the two earliest vaccines from Pfizer and Moderna need to be kept at very cold and very specific temperatures. And the problem is this: for example, Pfizer is distributing its vaccine in special deep freeze boxes of 1,000 doses each. Now, those doses have to be kept at a specific temperature and used within a certain time frame after opening the box. But you've got a lot of rural towns that just won't be able to distribute all 1,000 of those doses. They just don't have the demand for it. So to avoid the waste in a vaccine that's going to be in very short supply anyway, I think you get a lot of local governments using that express delivery to move these boxes around the state wherever they need them. The company beat its Q3 earnings estimates by 81%, and earnings are expected to jump 37% over the next 4 quarters to $15.51 per share. Between that long-term trend to e-commerce and this year-long boost from the vaccine, I think the share price can easily keep going to a price target of $350 a share. All my bowtie citizens out there are probably tired of hearing me talk about Macerich, ticker MAC, but I hear a lot of people talking about Simon Property Group also, and I truly believe if you're looking for a rebound play in this mall operator space, I would rather you be in Macerich than in SPG. Macerich owns 29 Class A regional malls, along with another 19 malls as part of partnerships, and then 12 non-mall properties. That's a total of over 50 million leasable square feet and averages $800 in sales per square foot, which is well above the average for mall property space and really just speaks to the quality of assets here. The company sold over $4 billion in lower quality malls over the last 8 years, so it really went into this whole pandemic, into this whole thing already positioned for that quality. Sales per square foot were down only 10% in the third quarter, and occupancy held up at 91%, which is really amazing considering that retail apocalypse. And now on that comparison with its larger competitor in the mall space, the Simon Property Group, I like Macerich here better because it doesn't seem to be getting mixed up in that retail business like Simon Property is, which is bidding on a lot of the bankrupt stores like JCPenney's. It's getting into the retail business. Instead, Macerich is focusing on staying a landlord, staying the landlord to these malls and finding new tenants like Amazon and distribution centers. Even on a lower dividend payment, which was cut earlier this year to protect the cash flow, these shares are still trading at a 5.5% dividend yield, which is why I also included this one in our dividend portfolio. Macerich is paying out just 25% of its funds from operations to cover that dividend, so once some of this uncertainty comes out of the economy, I think that dividend jumps back up. Now, with any of these rebound stocks, especially those mall operators, you want to look at the balance sheet to make sure that the company has enough cash to pull through this thing. Macerich increased its cash holdings to $530 million, which is enough to cover 19 months of its total operating expenses. So plenty of cash there and more than enough liquidity if it needs to borrow against some of those high-quality properties. Funds from operations this year are expected 34% lower to $354 million, so even after that big jump in the shares recently, the stock is still only trading for 4.6 times FFO. Now, I'm not saying this one gets anywhere near that $27 a share anytime soon, but this is a nice double-digit return over the next year, plus a per share dividend that actually could double from here. Diamondback Energy, ticker FANG, is one of the sole energy stocks where I think you could still get a 20 or maybe even a 30% upside even after the recent run. Shares of Diamondback have doubled since the March low, but the average analyst target of $55 could still mean a 35% upside beyond the 3.7% dividend yield. Diamondback has been aggressively cutting its rig count to bring those costs down and protect its cash flow. Capital spending is down 35% from its original 2020 plan, and operating costs are looking really good. Management reported cash operating costs of just $8.16 per barrel in the second quarter, which is among the lowest in the industry. Now, those costs came down 20% in the second quarter alone and should help to beat this quarter as well. The lower costs here have helped management commit to its $1.50 per share dividend, and the company is one of the best positioned for that eventual rebound in oil prices. Earnings cratered to $4.15 per share over the last 4 quarters, but management was able to beat those expectations by an astounding 69% last quarter. Analysts are expecting earnings to continue lower to about $3.58 per share over the next year, but even on this lowered guidance, the shares are still just 11.5 times on that price to earnings basis. So if we look at the trading history on this one, Diamondback traded for 14 times earnings last year, and I think it can go back to that multiple for a $50 price target. Beyond that, though, earnings are expected to rebound to $5.38 per share in 2022 for a potential $75 price target. So this is years of upside potential on this one and those dividends. Now you've seen those 5 best stocks to buy according to those analyst estimates, but not losing money is just as much a part of investing as making it. So now let's look at the 10 stocks to avoid. 10 stocks that analysts think could fall furthest, could fall 10 to 20% to their price targets. Here, FactSet has polled analysts to find the average target price and the 10 with the greatest downside compared to their current share price. And it's interesting that American Airlines tops the list here with a 20% downside to the average estimate, because it wasn't that long ago that most analysts were bullish on the stock. Now, I would agree here though. We did a video on airline stocks just a few months ago. All of them are in trouble, but AAL is probably the most indebted and the worst off in the major carriers in terms of that seat capacity it needs to become profitable. And just the likelihood that it gets there over the next year is pretty much zero. Now, a lot of the stocks to avoid on this list, though, are mostly just a function of the stock price outrunning those targets. You've got runaway stories like Twitter, which is up 50% over the last year. West Pharmaceuticals up 85% and Rollins up 50%. So these stocks may still be good companies, but they just zoomed past those price targets, so analysts are a little wary of the valuations and a pullback at this point. Now, Under Armour, ticker UA, is interesting here because even after an 18% loss on the shares this year, it's still 37% too expensive according to the average analyst. Earnings were absolutely crushed over the last 4 quarters for a loss of 29 cents per share versus posting a gain of 33 cents per share in the prior year. Earnings estimates are only slightly better, expecting the company to only lose 15 cents a share over the next year. And this probably shouldn't be much of a surprise, right? Under Armour is very closely leveraged to college and pro sports. The lack of games here has just taken those players and the apparel out of the public eye. Really, the primary marketing channel for this company has just disappeared completely. But the balance sheet here looks pretty good. All you out there in the nation know how important this is right now. For the hardest hit companies, especially in retail, I'm looking to make sure they have enough cash set aside and not too much debt so they can survive until these sales come back. So we look and we see that Under Armour has $870 million in that balance sheet cash against about $1.9 billion in long-term debt and those capital lease obligations, which is pretty good considering the year it's had. I just don't see any existential risk here with the stock, which means as those sports and as exercise gets back to normal, this one has the chance to surprise to the upside. Now, the stock has been a nightmare for anyone trying to call a bottom here, so I think you still have to be cautious, but if there's any of these first 5 here that I would go with, it would have to be this one. Now, Public Storage, ticker PSA, is another interesting stock here on the list. It's up just 7% this year, so not like the shares have really outrun that target, but it's still about 10% above the target analyst estimate. Now, I actually like this company and have owned it since 2010 in a retirement portfolio. It produces very stable cash flows and a 3.5% dividend yield, but right here, I'd have to agree it's probably at fair value at best. I wouldn't be selling here because I like the space as part of my long-term REIT holdings, but I also wouldn't be buying much either. Click on the video to the right for the 5 dividend stocks I'm buying for 2021. 5 of the best cash flow stocks to buy right now that pay more than twice the market average. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.